Okay, tonight, y'all, we have Nathan Ferguson on. He's a CPA. He worked for the Department of Education. He's in private practice now. If you are a school owner, if you are a potential school owner, you're definitely going to need his services. Everybody going through the NACCAS accreditation, every last school is going to need audited financial statements. And he's going to go through this with you all. He's going to do a little Q&A, but everybody needs Nathan's services. So without further ado, Nathan, can you introduce yourself, tell them your credentials, and will they be able to see you? Let me know.
Hopefully they can. Let's see here. I'm sorry. Let me see here, fix the video.
Okay, so they can see you now. All right.
Perfect.
So tell them a little bit about yourself, and then we're going to get right into this.
Gotcha, yeah. Hello, everybody. My name is Nathan Ferguson. I'm a CPA located out of Dallas, Texas. I do Title IV school audits. I help also schools get accredited, such as your own self that are going through the accreditation process. As a Barber Millionaire already stated, as you go through the accreditation process, whether it's NACCAS, COE, or wherever accreditation that's recognized by the Department of Education, you will need an audited financial statement. And what that entails is I, as an independent CPA firm, will come and audit your financials, your profit and loss, your balance sheets, and your cash flow statements to ensure that they meet what's called a composite score. The Department of Ed and accreditation agency, you have to have a 1.5 on a scale of 3 is the highest and a -1 is the lowest. You need a 1.5 or higher to pass. So that's where the audited financial statements come into play. I audit the financials, I calculate the composite score, and obviously the composite score is reported out in the audit report, which goes to your accreditation agency as part of the application to get accredited.
Okay, now, when a school first opens, just say they getting ready to open, can you tell them some of the things that they should be doing and some of the things that they should not be doing? Because their ultimate goal is to get ready for NACCAS.
Right. Yeah, as far as the financial side of the house, some of the things as far as NACCAS is one of the biggest things they have is a cash reserve requirement. So you definitely, I would recommend most schools will operate under an operating statement account, but you also want to open, I would recommend a savings account and put money in that savings account to help meet that cash reserve requirement if you're going through NACCAS. Also, what you need to do is actually let me review your financials before I audit. I always recommend a lot of schools send it to me so I can review to see if it's ready to be audited. So that way to see, I can do a rough draft to see if you're meeting a composite score at that particular time. And also what I help out with schools, let's say your fiscal year 2022, if you run a calendar year from January 1 through December 31st, and you're like, okay, my fiscal year is about to end up and obviously going to need an audit in 2023. A lot of schools that are accredited and that are going through the accreditation process will give me what is called the draft financial statements from January 1 up to usually October, November, some time frame. And I'll do a draft composite score for them just to kind of see where they're at. And that way they help strategize with these potential school owners to ensure that they help meet the composite score. So that way, when it's time to do the audit in 2023, there's no surprises. So.
Okay, now a lot of new schools that are going to be going through accreditation, they don't have a lot of money. I remember back in '98 when I first opened, I didn't have a lot of money, but I had Ms. Velma kind of coaching me, and I was still able to pass that composite score, although I didn't have a lot of money and I didn't make a whole lot of money. So can you let them know about that, some of the things they can be doing?
Yeah, some of the things you can do, like on the balance sheet, obviously you have your cash and then you have some accounts receivable where students owe the school. The biggest thing you want to do is make sure you reduce your liabilities. That's where a lot of new school owners will try to go out and go buy a new building and fix assets. Even though you have a building and it is an asset, it's called a fixed asset, it takes a while to depreciate. So I would recommend not running out if you don't have to go get a new building and things of that sort. So what you need to do is definitely keep as much cash if you can in the bank. Obviously, look at your accounts receivable. But the biggest thing is keep your liabilities low as possible. If not, pay them all off. So that way, the composite score is driven by equity on the balance sheet. So you have assets, you have liabilities, and equity. And obviously, if you reduce or almost have none in liabilities, your equity and your cash is going to go equivalent hand in hand. So that's right there will be a key component into the composite score for a new school owner. So you want to keep liabilities low as possible. Obviously, stack as much cash as possible in the bank. And obviously, we will look at your accounts receivable too, which all plays into your equity side of the house.
Okay, now, Nathan, when you say liabilities, what do you mean by liabilities?
So liabilities are things such as like if you got a lot of note payables, meaning you get a lot of loans out. If you got PP loans out, you want to get those forgiven before your fiscal year. A lot of entities took PPP loans out to help for payroll costs, but if you don't get those forgiven, they stay on your balance sheet as a liability until the bank forgives them. But most of the liabilities are things like accounts payable, that if you have credit card statements in the school's name that you still owe at the end of the year, accrued liabilities, payroll, obviously you can't get around sometimes. Those liabilities you're just gonna have to have, but the biggest liabilities that you want to reduce is loans. If you have any loans on there, you want to get them down, reduced to acceptable level. If not, try to pay almost all of them off to keep that equity as high as possible.
Okay, now, are those school business loans or personal loans?
No, this is all tied to the business entity. So it doesn't have nothing to do with personal. So anything that's tied to the business name, because it's the business entity, such as if it's ABC, for example, ABC Inc. is going to go open up, ABC Cosmetology School. So any loans that is tied to ABC Inc., even though Jane Doe might own ABC Inc. and Jane Doe got car loans, house loans, things of that sort, that's personal loans. That have nothing to do with the business entity loan as ABC Inc. Because ABC Inc. is the one that's applying for accreditation. That's the one that's on the application. So all liabilities tied to ABC Inc. in this example will go on the balance sheet. So.
Okay, now on the school liabilities, are those the expenses considered liabilities?
No, expenses are on your profit and loss. So you have your balance sheet as one part of the financial statement, your profit and loss is on the other. Basically, your profit and loss is all your revenue, usually your tuition, any floor sales you have, that will go on the revenue side of the profit and loss statement. And then all your other expenses like your utilities, rent, any usually basic business expenses, insurance, things of that sort will all be listed out in expenses. So the net income, once you take your revenue minus expenses, you either have a net profit or a net loss. And the goal is obviously to have a profit because that flows into equity. So if you got $2,000 in equity already sitting on your balance sheet, but if you got $1,000 in a loss, it's going to eat away at your 2,000 in equity. But if you make 2,000 in profit, it's going to add into that 2,000 equity already remaining. You got 4,000 equity. So the goal is, especially with NACCAS, they always want you to produce a profit. At the end of the year, you can still take a loss. You don't want to take a big loss because big loss can affect the composite score in the calculation. There's 3 components of the composite score. You got equity, primary reserve ratio, and the net income ratio. And if you take a huge loss, which revenues minus expenses give you a net loss, if you have a net loss, it's going to hurt that net income ratio in the composite score. It's made up of 3 components. So.
Okay, now, on equity, can you explain more on what equity can be?
Right. Equity usually is, like I said, given to the profit and loss section. You have your revenue minus expenses. That net income or the net loss flows into equity on the balance sheet. You got assets, liabilities, and equity is the 3rd component of the balance sheet. So that's one component that affects equity. Contributions, meaning I own ABC Inc. and I'm putting my own personal money, Jane Doe, into ABC Inc. of 2,000. 2,000 will come on the cash side of the balance sheet. 2,000 will go in equity. It doesn't hit the P&L because it's not revenue. It's money I'm contributing to the company, which helps out a lot in the composite score. Owner contributions is a big key that helps the composite score too. So you can take distributions, meaning you take money from the company, that hurts the composite score. But as long as you're contributing money to the company, then it's going to help out the composite score too as well. So a lot of owners will contribute, especially when it gets near close to the end of the year or even throughout the year. they'll contribute more money to their company, and that way it'll boost up the composite score because they'll increase cash and increase equity on this side too. So usually the biggest thing to increase equity, which is part of the driver of the composite score, is making a profit every year and contributions. So if you take a lot of distributions, then it's going to hurt your equity, which in turn hurts your composite score. So
Okay, now distributions, that's taking money from the school, is that correct?
yeah, so if you had, let's say you started a company, again, back to ABC Inc., you contributed when ABC Inc. started $10,000 to start the company. So you say, hey, after a couple months go by, you want to say, I want to take $2,000 out of the $10,000 put in. So right now you might have been sitting $10,000 in the bank, $10,000 in equity. Let's say you want to say, okay, another month goes by later down the road, you want to take $1,000 out, you withdraw $1,000. It's not an expense. You're just taking money from the company out of your own equity that you have in the company. Instead of 10,000, the equity goes down to 9,000, just like cash will go down $1,000. So it's money taken out from the company, which in turn hurt equity because you're reducing your cash, you're reducing your equity, and it hurts your composite score too. So of course, the more money you put into your contributions, the more equity you got in the company, and there's a better chance it's going to help out your composite score.
Okay, so if a school's working with you and you're kind of monitoring those figures, and you're kind of noticing that they may not make it, or it's going to be kind of borderline,
Mm-hmm.
and you see that ahead of time, what advice would you give that school owner to give them a better chance to pass?
Yeah, so given, like, let's say if I audit their 2021, obviously it's historic, it is what it is. But given like 2022, like right now, the school owner reached out to me and said, hey, I want, to make sure my financials of 2022 are in good shape. I will look at their profit and loss and balance sheet. Those are two financial statements I would look at. And I would see, let's say we did it from January through October, and they got with me in early November. They said, here's my books, here's my profit and loss, here's my balance sheet. First thing I'm going to look at is the equity side of the house to see where it is. Second thing I'm going to look at is the liability, see how much debt that you are carrying. Third thing I'm going to look at is to see, obviously, will that profit and loss, how is it flowing into the equity side? Are you making a profit or are you making a loss as of January through October? So obviously I'm going to say, hey, if you can reduce your expenses, obviously to help out, if you can, maybe add contributions to it. If you can, maybe you need to boost up floor sales, things of that sort to get revenue, get on up, get increase, make expenses decrease, which in turn increases your profit, which flows into equity. And also I would say, hey, you may want to contribute X amount of dollars, because each scenario is different. Obviously, each school's different, the money's different, the P&L is different, the balance sheet different. So once I see how the numbers flow, then I can help you strategize better on what the magical number is, whether it's contributing here and reducing expenses here, because obviously you still got 2 months that impact, can play a part of it. But for the most part, as people know, business goes in waves, they go in cycle, and they kind of almost got an understanding what the next 2 months may be. So therefore, giving them a good cushion magical number will help out, ensure that they meet that 1.5 or above composite score. So
okay, so with the equity, that revenue versus minus expenses, then that's equity right there. Is that correct?
yeah, equity is your assets minus your liabilities.
Okay.
So
now,
assets minus liabilities will equal your equity. Now, profit, your revenue minus your expenses will equal net income or net loss, and that flows into equity on the balance sheet.
okay, now when you say equity, can
Mhm.
you explain to everyone what all equity can be? Can it be a car? Can it be a house, land?
Right. So equity will basically on the balance sheet, you'll have items listed out like your cash, you have accounts receivable, like if students owe you money at the end of the year, that'll be accounts receivable. You'll have obviously fixed assets. So I'll highly recommend don't go out and purchase a lot of tables, furniture, especially if you're starting up, because they take so long to depreciate. Obviously, you need it, you got to go get them. But keep in mind, a lot of fixed assets actually, the net fixed assets actually hurt your composite score. So a lot of school owners, if they're going out, only got $1,000 in the bank, they didn't pay $5,000, $10,000 in fixed assets. That's like fixed assets are tangible things that place in service longer than a year, like your laptops, your computers, your furniture and fixtures, all those things come up 10,000, but it only depreciates for that year. let's say $2,000 is depreciation expense. So you're at an $8,000 net fixed assets, right? So you got 1,000 in the bank, 8,000, so 9,000 in total assets, right? And then maybe you have no liability, so you got 9,000 in equity. But that 8,000 fixed assets is such a big number, it gets backed out of one of the ratios. So that, let's say you got to be very mindful of how much fixed assets that you buy, especially that first year, because I always say, hey, let me see what you have. Maybe you just might want to hold off the next following year to buy more tables, more furniture, especially when you're starting up. And, that can play a big role into it. So that's why it's very important to have a lot of cash in the bank. So all those assets will equal, minus the liabilities will equal what's left over equity in the company. So.
Okay, now, if you didn't have a lot of expenses for that year with your school, and you didn't make a whole lot of money, but
right,
expenses were so low that it came out a positive, would that help?
Oh, that helped out big time. So for giving to your example, let's say you make 20,000 in revenue. You taught a couple students, you make 20,000, you only have 5,000 expenses, right? So you have 15,000 in net profit. So that 15,000 rolls into your equity. So obviously the bigger the profit, it helps out with equity. But what you don't want to do is take distribution. You see how I could take 20,000 distribution, now I'm at a negative 5,000 for the year. So that's why I say you got to be mindful. Don't take distributions if you don't have to take them. Contribute until later down the road your equity builds, and then if you need money, then obviously get money. But that's the big key, is you want to monitor that equity.
Okay, now looking at schools' revenue versus expenses, what would you say are some of the top expenses, like employees? Can you go down that?
Yeah, some of the top expenses, and like I say, each school kind of operates a little bit different, whether they contract it out or they have salaries and they have payroll tax. But for the most part, rent is your biggest expense that I see. Payroll is the biggest expense, whether salaries or you're treating them as contractors, 1099. Utilities is always usually another big expense. Telephone is usually another big expense starting out. Insurance obviously is a big expense. So, you have a lot of startup costs too, as well, for license and things of that sort. So those are your key big expense that you probably need to manage, so what a lot of folks I see, they'll get away from payroll and do a lot of contracts so they won't have to pay the payroll tax. So I think they help reduce some expenses there, and then later on, I guess they'll treat them as employees and things of that sort. But those are the biggest key expenses that I see. But you want to make sure you're bringing enough revenue, whether it's through floor sales and tuition. Obviously, you're going to make revenue through tuition because you're teaching students, but a lot of people bring in a lot of floor sales to help supplement that revenue to cover those expenses to make a profit at the end of the year. So, which helps out the equity side.
Okay, now you told us about distribution, taking money from the school. What are some of the other things that they need to limit or not do?
Yeah, like I said, the biggest thing, again, I can't say just be careful, mindful. Distributions is the biggest thing. Monitoring your financials, like right before the end of the fiscal year, is the key to making sure that you pass the composite score. That's the biggest. I take a look. It's like tax planning, right? So most people, hopefully they prepare for taxes offset the year. Some people just go through work, get a W-2, be a contract 1099, and think about taxes later. However, if you properly tax plan a little bit, you kind of almost can gauge what your tax liability is going to be at the end of the year, the following year when you file your tax return. So planning is the key important component of passing this composite score. Like I say, auditing the financials is a must, but part of that financials, what the accreditation agency and eventually DOE is going to look for, they're both equivalent, the same on the regulation, is that 1.5 or higher composite score. And the way you do that, you have to monitor where are you at before the fiscal year ends. And that's why I audit a lot of Title IV schools, and they always get with me before, especially if they're high risk of, like, if they made a 1.5 last year, 1.6, they'll get with me around October, November, send me their draft financials, profit and loss balance sheet. And then I will strategize with them and give them the same strategies work, the same part as new schools going in. It's all the rules are the same. They get with me, I strategize, I tell them, and then when it comes time to do the audit, it's a great chance of passing with no problem. So.
Okay, now, if they wait till December 31st,
No, it's not gonna work. Yeah, what's done is done. It's almost like waiting to December 31st to try to tax plan and do, save money on taxes and all that stuff. And once the clock runs out, the clock runs out. It's a whole new fiscal year. It's a whole new year. That's why I tell folks with fiscal years from January 1 through December 31st, get with me October or early November. Usually they want to go ahead and probably most people get with me around middle November. So that way they have January through all of October books already done. And then around first week of November, that's when the calls and the emails start trickling in. And then from there all the way to near Thanksgiving time, folks are flooding me with me. Hey, look at my composite score. Can you take a look? It doesn't take that much. Once I got the information, I can tell you, hey, you looking good, or hey, I see if it was December 31st, this is probably where you at, and you may want to do X, Y, and Z to, increase your chance of getting a better score. And obviously, if you wait, even if you wait till 1st of December, it's going to be a better snapshot because you got a whole nother month of actual data. Did that make sense? So some schools actually don't want to wait until November because they're like, I don't want to be unpredictable that much, and they'll wait and give it to me the first or second week in December and give it to me. And I can still strategize with them and say, hey, they can control their expenses, but at least they know, okay, maybe I need to do X amount of contributions just to clear the bank, get the cash up, things of that sort. So.
Okay, now, when the school first opens, not like with NACCAS, you can't apply with NACCAS candidate status until you've been open for 18 months.
Mm-hmm.
And then going through the NACCAS process, it's going to take another minimum 18 months. So that's about 3 years.
Mm-hmm.
When do you feel that they really need to have those financials together? And what year are you going to audit?
Yeah, well, NACCAS, when you're going through the application process, NACCAS is going to want your most recent fiscal year. So obviously, as you apply, right, as soon as you apply to NACCAS and you go through the application process, they're going to eventually request from the school owner the most recent. So if they apply now, let's say they, applied back in whatever, September or August of 2022, part of that application, they're going to want a requirement is your most recent fiscal year audit. So you would have to get your 2021, if you ran a calendar year, January through December, that's your most recent fiscal year audited. And that has to go to NACCAS to be part of the application because they're not want to dig and wait till you do 2022. They want the most recent as part of the application. So.
Okay, now when they're doing the application, when they're going to get their final visit, they want those financials too. So
right.
What have you seen has been, I guess, like some of the biggest mistake? Because I know after December 31st is nothing that you can do because those statements, the bank statements, you're going off the bank statements. Is that correct or what?
Right. Some, we're auditing the financials, so everything that clears the bank. We're going to part of the audit is reviewing all the bank statements for the whole year. Yeah. So the biggest thing I see with the new school owners is finding the right person to do the financial statements, like preparing the financial statement, basically doing their bookkeeping. So they either will hire a friend, sometimes that can go wrong because they don't have the expertise, to do the bookkeeping piece of it. So what I always recommend is obviously if you're going to hire somebody, know that they got, a financial statement, preparing a financial statement experience. If not, you can easily get QuickBooks online version is what I recommend. That's a simple accounting software, that be able to track and produce the reports that we need if when we come and audit your company, or go hire obviously a CPA firm, which can be a little costly. But the whole goal is to have somebody that has a knowledge and expertise, because when the site visit comes in and they're looking at those financial statement standards, yeah, they're looking at the report and they're seeing that you're passed and all that good stuff, but they're going to ask about process and controls of who's doing your financial statements, your segregation of duties, who's preparing the budget. So things of that sort, instead of just, they see the output of the report and see that you passed, but you won't be able to clearly explain to them that here's the process, this person's doing it, or I'm doing it, and this is how I account for it. This is how I reconcile the bank statements back to my accounting software. Or I have Joe Blow from the CPA firm that does it, and they're qualified. So you just want to make sure that you have a well-defined process of tracking and accounting for your financial statements, basically.
Okay, Nathan, how have you seen a lot of the smaller schools passed that were small, they
Mhm,
didn't make a whole lot of money or whatever.
mhm.
Can you talk a little bit about that?
Yeah, the way I see a lot of smaller school pass is that they keep their liabilities down, so they have next to hardly no loans on the books. They keep as much cash on the bank, as in there. Obviously, they'll record their receivables if student owes them money. And that way, even let's say like it's 2 years, worth of financial statements that they've been in obviously in business for, and I'm auditing their second year in business or something like that. They will have hardly next to no loans on the book, a couple thousand at minimum in the bank there, and maybe a handful of receivables that the student owes them money as of December 31st or whatever the end of the fiscal year. And then their equity is high and they're making somewhat of a profit. Even if they take a loss, it's almost next to nothing, like $500 loss, after everything, right? It's not a big enough loss where it's impacting equity. You with me? Because they got some kind of money in the bank, they're contributing, keeping money high as much. That's what I say, open up a savings account. That's what I recommend. Most people go through an operating account when they open up. And when I'm auditing a lot of new schools, especially with NACCAS, is the one that has this cash reserve requirement. They require 3% down just for cash reserve requirement. So what I recommend is that of they call it look back period of their revenue from the previous year of 3% in cash. But I always say just get a savings account, stick a couple $1,000 if you can in that savings account. That way it counts as equity, because obviously cash is equity. It's sitting in there. It'll help make sure you pass the cash reserve requirement. And even when you get accredited, that cash reserve requirement doesn't go away. So it helps to make sure that you got a control in place that is like almost like investing in yourself when you're, as a personal person, when instead of looking outside the business, people open a savings account, they make money and they put money in savings account. It's investing in yourself, just like the NACCAS is requiring this cash reserve requirement. And what a lot of new school owners would do is just operate under the operating account, but they're unaware that this cash reserve requirement needs to be met. And if you don't meet that cash reserve requirement, and I have dealt with Title IV schools that NACCAS has shut them down because not meeting that cash reserve requirement. So that's very important that you have to meet that cash reserve requirement. And my recommendation is open up a savings account, stick that percentage of money in there in the savings account. So, and combine with your operating and savings, it'll help reduce the risk to make sure you meet that cash reserve requirement. But as a new school owner, I get it. There's not that much cash. Usually you're buying stuff, you're trying to get rent, payroll, and all that good stuff. But that's why I say contributions will come into play. If you can contribute as much as you can to the company starting out to keep that equity high, and get with me or whoever's doing it before the clock runs out to make sure that equity's high and that composite score is met. So you won't, have no problem with the cash reserve requirement and the composite score, especially if you're going through NACCAS. That cash reserve requirement is a NACCAS requirement.
Okay, now the cash reserve requirement, you said something
Mhm.
about 3%.
Yeah, 3% is what they say. So once you get accredited with NACCAS, they always do that 3%, what's called the look back period. Basically, it's whatever that you made in revenue. So if you made, let's say, 10,000 in revenue, 10,000 in revenue, they want $300. It's 3%, 10,000, $300 sitting in the bank. I mean, cash or cash equivalent, they call it, sitting in available at all time, 9 out of the 12 months. So 3 of those months have to be of your fiscal year. So if you're running through a January through December, October, November, December, your average bank balance needs to be at least 300. Right. So that's out of the October, November, December months. And then the last remaining months, January through September, they give you a free floating of 6 months. So 3 months you could miss it, but 6 of those months you have to meet it. So it's basically 3% of your revenue from the previous year. You with me? So what I always say is and most schools operate, especially new schools, they get a bank operating account, or you're just paying money, paying bills, paying money, paying bills, and that balance is fluctuating so much. But to ensure that you meet it, just open up a savings account, stick that money in there, and then that way you got some cushion, so you have a good balance of meeting it. And if you don't meet it, especially in savings, at least the operating is there to kind of balance it out. Did that make sense?
Yeah, so you're saying 3% of the total revenue
from the previous
from
year.
the previous year. So basically,
Yeah,
if the previous year they made $100,000,
yeah.
they only needed to have $3,000.
The average balance, right, needs to be $3,000,
For at
correct?
least 6 months. I mean, at least 9 months.
Nine out of
Nine out
the
of the
12
12.
months, right? But your last three physical, and NACCAS requires that last 3 months of your physical year is a must. So they give you free floating for the other 6 out of the 9. So what I always recommend a lot of school owners, especially with NACCAS, open up a savings account, stick that money in there. For this case, if it was 3,000, stick that money in there at 3,000. Sometimes I always tell them stick more, just 4,000. That way it cushions, because what happened, it'll fluctuate from year to year, because you may have a good year one year and a bad year another year, or you can have year one you did good and you got, like you said, at 3,000. Then year two you may turn around and have double that money as you grow, especially new school owners to grow. So the reserve requirement is getting higher and higher, but at least you got a cushion already there, and you can always, so the years you do bad, you're going to pass, probably you got a better chance of passing, but the years you do good, you can just start adding to it, and you got a cushion instead of banking on your operating balance account, because it's going to fluctuate so much when you bring in money in and paying payroll, and you just don't want to run the risk of missing that cash reserve requirement.
Okay, when you say a savings account, is it a
Mhm.
savings account for the school or can it
Savings
be
account for the school. Everything
Okay.
you do, it needs to be done. That's a great point. Everything you do, don't put it in your personal name. Put it in the school's name. Like, because when I audit, and a lot of school owners will say, hey, I own the school, it's a person. But I'm like, if it doesn't say ABC Bank Inc., and that's because I'm auditing the entity. I'm not auditing the individual, I'm auditing the entity. And they'll say, well, Nate, I got other personal savings. I'm like, that doesn't count. It's your personal. You got to treat it separately. So whatever, in my example, ABC Inc., and if that's what you're applying to NACCAS, that's what your financial statements are, that's what the balance sheet, it's about rights and obligations. So if ABC Inc. has an operating account, open up another savings account. In my example is ABC Inc. and stick the money in there. And then it shouldn't say your personal, your name in there and say, hopefully this year. It doesn't work like that. It has to be in the entity's name, because I am auditing, or a CPA firm is auditing the entity itself financial statements, not you as an individual.
Okay, now what about co-mingling accounts and treating that school business account like a personal account, just buying stuff like it's your personal account?
No,
Can you hit on that?
that is a big no-no. Do not, you'd be amazed of how many times I see that. No commingling. Treat everything separate. Personal's personal, business is business. So it has the separation. So and that's the biggest thing. And that's a great point. I have been in audits where they commingle, and that audit gets real digging. I'm gonna ask a lot of questions. It's gonna be a lot of receipt, and it just brings into a lot more things in the question to play. And you need to keep it crystal clear, because if I'm auditing ABC Inc., give me the bank statements for ABC Inc., and all your financial transactions should cross-reference the bank statement, and everything should reconcile, flow. But you can't only do that if you have a separate bank account for ABC Inc., not my personal account, and I went out and bought some supplies and things of that sort, this and that. Well, I can't see it if it doesn't hit the bank statement of ABC Inc. So keep business, personal is personal. Keep them separate, and open up. If they haven't now, they need to go out and open up the business operating account and the savings. I highly recommend that savings too, in the company's name. That's the biggest key, in the company's name. Because first thing I do when you give me when you give me not audited, but when you give me financial statements, whatever the business entity is, you give me your LLC, you're giving me all your IRS EIN, so all the business information is lining up. First thing I'm doing is checking the bank statements and making sure, does the bank statement has the business name and not your individual personal account, that you got auto loans and everything else, and I can't tell what's what. And if it's personal, it's just not going to work, because it shows that you don't have controls and reconciliation in place for financial reporting. So that's a great question.
Okay, now a lot of schools, when they first opened, that first year, it's like the Wild Wild West.
Mhm.
So if they've done that, then the second year, can they go ahead and get on track because they didn't know what they was doing the first year?
Yeah, there's nothing wrong with getting on track. Like I said, you're absolutely right. Do it now. If you got a personal account and you're running your business through that, you need to go to the bank tomorrow, open up an operating account, get with your accountant, and things need to be linked to that business operating account and that savings account if you can, and operate totally that way and leave personal. Business needs to be business.
Okay. Because I'm asking you all these questions. I mean, because we've been having school 20 years. I've done talked to 1,000 different people, all kind of
No worries.
scenarios. So I
No
want to
worries.
play devil's advocate, like
I
what
got
they're
you.
thinking. Because a lot of these questions that I'm asking you, a lot of people scared to ask you this because
No,
they
I mean, ask away. I'd rather deal with it now and clear it up and give good policies and practice in place. So that way, because the whole point is when it comes to do the audit, I'm looking for internal controls, who's doing what, process in place. And you're absolutely right. These are things that I see all the time, and it doesn't happen until the audit comes out. And then the audit becomes brutal because it's hard for me to determine what money's coming in, what money's coming out as a personal, as a business. And it's a lot of digging where the audit can go a lot cleaner, a lot faster, a lot easier and that's the first thing I say is, well, why didn't you open up another account for the business instead of commingling? I get it. You're trying to do it, you're trying to work it, you're trying to just get things started, and the money's is easy to deposit and expense. However, it's not good business practice, not good internal controls. And when especially when you start accounting on reconciling it, I just can't see how you can reconcile the financial accounting, whoever's doing your books, on your personal statement. It's almost an accounting nightmare. So it's easy to don't keep it commingled. Obviously, you want to keep everything that when you give your auditor, say, hey, here's my January statement, February, March, they know everything's tied to the business. And then when I see the general ledger, the financial statement, everything tied and cross-referenced together is clean.
Okay, and we'll do some Q&A in a little bit. Now, what about people going to jail? Because even when I first opened my school, all these, I can go ahead and say it, because I was a convicted felon, I went to prison for drugs or whatever, but everybody kept saying, well, you going back to jail, you get to fool with that government money, you going to prison and stuff. So it's like this little, people always saying it, because you worked at the Department of Education. How long?
Yes. Yeah, I was there for 10 years as an audit manager out of the OIG's office.
Can you hit on people going to jail?
Yes, there is. Now, biggest thing we look for obviously is fraud, waste, and abuse, and especially of federal funds. So we have an audit division, which I was a part of. We would come out and do a lot of audits in proprietary schools. And then obviously when it came down, there's one thing of making errors and things of that sort. And obviously you have to return the funds if it's not meeting regulations and things of that sort. However, when you talk about fraud, waste, and abuse, we have an investigation department at the Department of Ed that they're just like law enforcement. They come in and OIG, correct. And that's the office that I worked at, on the Office of Inspector General at the U.S. Department of Education. So we have an audit division and we have an investigation division. So I worked in the audit division. I went out just like I'm doing now for the public sector, but obviously working for the federal government side. I went out, audit proprietary schools and other entities that receive federal funds. We would do audits, but obviously when you get to the point where fraud or waste and abuse comes into play, especially fraud, and that's intentional, then we would summon, obviously, the investigators would get involved with it, and then there's the law enforcement, and then they would obviously act accordingly to build a case, and then obviously lead to prosecution, obviously when they get the district attorney and things of that sort involved. So absolutely, yeah.
Okay, so basically when you're talking about fraud and waste, that's like if they got dummy students, a student that doesn't exist, or they got a homeless person, social security number, and federal funds, or students would do a refund check and the school's keeping their money, things of that nature. Is that what you're talking about? Or
absolutely, yeah. All that's in the naughty list. So you don't want to do that. I mean, it's different than making an error where you're supposed to, once you get Department of Education fund type of funds, and payout should have went back in $2,000, and you only calculated 1,000, and you kept the other 1,000 based on miscalculation, error. We catch that all the time as auditors. That's just happens. But it's different when you're sitting there talking about, well, hey, as you said, you're getting homeless people or ghost people. They enrolling all these fake people just to draw down funds and things of that sort, and it's not used for the intended purpose for the education and things of that sort. So they just got to be mindful. Obviously, if you're signing a program participation agreement, you're signing with the rules and regulations that come with it, with meaning that students that are eligible or the funds are being received for eligible students to get dispersed as they're supposed to. Funds, students that drop, obviously doing a return of Title IV, giving funds back to the department as required. But anything obviously outside of that scope of realm where you're doing fraudulent intentional activities to defraud the government, and obviously it's going to come to a legal matter, and that's when the investigations get involved. The auditors too, but the investigations team will definitely get involved.
Okay, and when a school is receiving Title IV, the government money, they're accredited, now they've gone through the Department of Education. So every year, the school is audited.
Yeah, and that's a good point. So when you get started with the accreditation, you have to have a financial statement audit every year. That's accreditation standard. So once you get through the accreditation and you go through the Department of Ed and go through their process, you can sign a program, what's called program participation agreement. And that'll be whether you participate in Pell, direct loan, both programs, or how many programs you want to decide to participate in. You're going to need what's called a compliance audit too, in addition to the financial statement audit. So there's going to be 2 audits involved going on at the same year. So for prime example, you may need a financial statement audit now. We're in fiscal year 2022 for NACCAS. So let's say in 2023, you get your fiscal year, your look back period, year 2022 audit. So as you go through the DOE's process, you get the program participation agreement in July of 2023. You start drawing down funds for Pell and direct loan at the end of 2023. So time when I'm coming to do the 2023 audit, which is in 2024, you're going to need not only a financial statement audit, because you have to have that every year, you're going to need what's called a compliance audit. And DOE, Department of Ed, requires the compliance audit because you're participating in the Title IV. So it's just there as part of the requirement. As you're receiving these Title IV funds, you are required to get what's called a compliance audit to ensure that you're using the funds appropriate. Are you doing student eligibility? Is the institution eligible? Are you dispersing on time? Are you returning the funds on time? That's different than a financial statement audit. And both those audits, the financial compliance audit, gets submitted to the department every year. So like if you have a calendar year, January through December, you have to submit the financial compliance by June 30th. So they give you 6 months to complete the audit. However, keep in mind, the same financial statement audit can get submitted to NACCAS too. So DOE receives that financial statement audit, and NACCAS, in our example, will receive that financial statement audit. It's just that compliance audit only goes to the Department of Ed, since they're the ones that's giving the funds out to the school or to the entity. So it's 2 audits, the financial compliance. DOE and accreditation agency gets a copy of the financial because they want to make sure you meet the composite score, obviously, because the accreditation standard you have to hit. DOE, it's a requirement of participating Title IV that you meet the composite score. That's why they want to see the audit, and they want to see the compliance audit to make sure that you're spending the funds correctly. And if there's any issues, so that way they can take appropriate action if they need to be. And once a school owner gets involved in Title IV, they'll be assigned usually a specific region. If they're like out here in Texas, they'll be to the Dallas regional office where I worked out of. And Dallas regional office covers multiple states, like the other Atlanta office covers usually a lot in the Southeast, Georgia, Florida, things of that sort. Texas region covers Texas, Louisiana, Arkansas, so things of that sort. So it still gets reviewed by folks in DC, but the regional office is the one that's usually assigned. It's called School Participation Division, that you'll have a contact that usually signs. So if there's any issues as we go out and do the Title IV audits and go through the reports, and let's say we find funds that should have went back, it get written up in the report. The school owner has to obviously submit back the funds back to the department, but that region will be responsible for overseeing that school to make sure that they're complying.
Okay. Now I know this is a lot, but how important do you feel the third-party services are? Like the smart system.
Oh, yes.
Because I tell them as a school owner, what you're talking about, I know this is blowing their head up.
Oh yeah, it's a lot. It's baby steps. Like I say, the first thing is baby step 1 in my mind is get your financial statements in order. Once you got a structure and a process, you want to make sure you find the best qualified person that to do it. Even if it's yourself, you want to make sure you have some kind of accounting software to do it, the proper account. And like I said, I recommend QuickBooks Online. It's quickest, fastest to get your accounting software online. So once you get that step going and process going, then obviously as you go through the accreditation process, then you want to probably determine what third-party servicer you want to use to help you make sure you meet those Department of Ed regulations, because third-party services is going to get come in as a partnership with the school owner when you start receiving Title IV funds to ensure that you're in compliance. So like there's a lot of servicers out there, like I say, that you can use. But it's up to you to determine which one you want to use. But I would highly recommend getting a third-party servicer once you start participating in Title IV funds.
Okay, and because a lot of school owners are going to listen to this, they're listening to it right now. So if they got a good bookkeeper, I know Ms. Velma told them, she had me to get a bookkeeper. I mean, she referred the lady, I still refer her. And then she said, get a good, CPA, somebody do the financial. I refer everybody to you. So a lot of the school owners are listening to this and going to be listening to this, and they think that they got to do all this, but they got to do a little bit, but the CPA, that's what they're hiring you to do a lot of that. And then the bookkeeper is going to be keeping up with that stuff monthly. So you as a school owner, you don't need to be that stressed out thinking, oh, I got to do this or that. No, you're going to have to do a little bit. So you want to hit on that?
Yeah. So basically, you're absolutely right. So as the owner, you're still obviously responsible for the financial statement. However, you're absolutely right. That's where you need to surround yourself with a good team, basically. So you need to find somebody good and highly qualified to do the books, so whether it's a CPA firm, whether you know a good bookkeeper locally. So you need to find somebody who's expertise at doing the financial statements and the books. Where I come into play is I'm auditing your accountant or your bookkeeper to write up the report to say, hey, he or she did the books, this company did the books accurately, everything's good to go, and they passed the composite score. So those are the two components where the bookkeeper has their job throughout the year to keep you involved in the financials, letting you know how you're doing. Where me and my firm come into play is we're auditing that bookkeeper to make sure that they're doing their job correctly. All the accounts are correct, the numbers are accurate, and the school is meeting the composite score. So that's where I come to play. I write up a report on your entity saying, hey, I audited for this time period, and yes, they did, or no, they didn't meet the composite score. And that's what the accreditation agent and NACCAS use to review that report to say, okay, this school is financially good to go. So, but you're right, the team is very big, and finding a good bookkeeper is the key to the financial part.
So
and then
what I'm gonna do, I'm gonna give y'all a good bookkeeper. I just put her name in the chat. Now I'm gonna give y'all a good auditor, a good CPA auditor. I don't get paid to refer these people either. I ain't got no skin in the game. I don't have a school, anything or whatever. I'm just referring y'all to some good people so y'all won't be stressed out and worried, gosh, that's a lot. How am I gonna do it? No. Look, how did you build your house? You hired a contractor, whatever. Simple as that. They don't worry about cutting their hair, doing their hair. They come to people like you, an expert. So in order to do something that's difficult for us, hire an expert. That's all. So let me give y'all a good CPA auditor. I'm gonna give y'all his number right now. I'm putting this in the chat box. If y'all forget any of this, all y'all gotta do is call me, DM me, message me. Y'all know how to contact me. So I'm doing this right now. All right. So this CPA, I'm giving y'all his name right now. His name is Nathan Ferguson, and y'all looking at his face right now. Light-skinned man with a beard. Okay. So now, anything else did you want to share? If not, can we do a little Q&A and then?
Yeah, go ahead, shoot, fire away.
Because I'm gonna put this on YouTube also. So
No
school all over gonna be looking. All right, so let me go back through the chat to answer these questions that they had. Let's see. All right, I want to get to the questions. Okay, well, he answered how much should be in savings. 3% of what they made last year, correct?
Yes, at least
At least.
3% minimum.
And what he means by 3%, if you made 100,000, that's at least 3,000. If you made 200,000, that's at least 6,000.
And that needs to be, that's the average daily balance on the bank statement. So that's your average balance that you need to have 9 out of those 12 months for NACCAS.
If you made $1 million, at least 30,000.
Yeah.
If you done made $1 million, if you can't put 30,000 in, that's shame on you. All right, let's see. How much do we have in yours? All right, so he answered that while going through NACCAS. Let's see. I use QuickBooks. So somebody said, I guess I need to hire a CPA, LOL. I mean, he said QuickBooks was good, but I definitely get that bookkeeper, y'all. Let's see. How soon do we need to get with him? I just opened in July. They just opened basically a couple of months ago.
Yeah, because they still need, it got to be a whole year financial statements that I need to audit, given, like you said, your timeline is the 18 months and things of that sort. I'm going to audit your most recent fiscal year in order to be included in part of the application.
Okay. How often do you do these financial statements?
I do them every year. So like I said, we audit a lot of Title IV schools all across the country, and we help, obviously, schools getting the credit, so they have to need these audits as well. So you have to do the audit, financial statement audit every year. And then when you get Title IV funding, you'll get what's called a compliance audit.
Now, if a school opened today, record time, it would take them about 3 years to get accredited. That's doing everything perfectly correct.
Mm-hmm.
When do you really recommend that they need that audit? At what year?
Whenever, well, it just depends when they're applying to NACCAS. So they applying to NACCAS, okay. Right? That's going to be part of the application process.
Okay. On his fees, y'all can call that 214 number. As far as his fees. Okay, are they looking for a certain number, or are they scoring off how you handle the finances?
Yeah, so like I said, the composite score is made up of 3 ratios: the equity ratio, primary reserve ratio, and the net income ratio. I know I'm getting technical, but just to put it in layman terms, those 3, but equity is the driver. Like I say, equity, so I couldn't tell you where you stand, not you, but a business entity where you stand, until I see your profit and loss and balance sheet and all those different variables I was explaining, like your liabilities, whether you're making a profit or loss, all that determines your equity and what the end result of the equity is going to be, which obviously, as a result terms, plays a factor into your composite score. Okay,
I pay myself through the bank transfer. Is that good?
Well, I mean, you can pay yourself, but it's just depending on what type of entity you are. So, if you're an S Corp, then obviously, yes, you can pay yourself however you pay yourself. And whether it's through your payroll company, that can be answer many different ways. I would have a lot more questions on that.
Okay, that word we use, commingling, that's basically mixing the school account with personal account, mixing everything.
Right. So I always say, like, getting back to our previous conversation, don't commingle. It needs to be a separate bank statement for the business itself, and not commingling in your personal statement. Everything needs to be separate. Business and personal needs to be separate.
Okay, Sharonda, you said something about what if they're disabled individuals. Give me more information on that. Okay, what if you move from one location to another location? That doesn't matter if you change locations of your school.
No, it's the entity itself getting audited, not the location.
Okay, let's see. Well, a lot of people are saying, wow, this is a lot. Okay, when do they need you? When they first open the school, or when they start?
I would say they can reach out to me if they need me when they first open the school. But the biggest thing when they first open the school, obviously I can't do anything as far as performance services with them, because what I perform is audit services. So that doesn't happen to, obviously, at least, a whole fiscal year's passed. And then that's when obviously I will audit their most recent fiscal year. The best thing I can tell new school owners is like you said before, if you're commingling, go get your own bank statement, bank account in the business name, and find a bookkeeper, or if you plan to do it as an owner, do QuickBooks online. I recommend the online version, not the desktop version, but the online version. So that way you could be remote anywhere you access it. You can give me guest access as remote. And you at least have some kind of accounting software to reconcile those business bank accounts to your QuickBooks software, if you plan to do it as a owner, to do the financial accounting of it. But if you obviously plan to outsource it, whether it's a contractor or you have a friend of yours that's real good at QuickBooks or another accounting software, then obviously you would just pay that individual and they would run off with it.
Okay, Darlene. Okay, so you're asking some NACCAS questions. We'll talk about those later, darling. You can email me or text me. What are the fees? Okay, all of his services, he has different fees and services. So make sure y'all call that number that I put up. Let's see, I just changed from an LLC to an S Corp. Does that affect the audit?
No, that's only a taxing structure. That doesn't affect the financial statements of the audit.
Does it matter if he's out of state or should we find someone close? No, it doesn't matter. He's out of state.
No, I audit schools all across the
Everywhere.
US. So yeah.
Do you need payroll, personal payroll to qualify through NACCAS?
No, again, it's about meeting the composite score. You know, payroll is just payroll doing expenses. So
I
it
wasn't
just,
paying myself.
yeah,
when I
and a
first
lot of
opened.
school owners, like I say, a lot of school owners won't pay themselves because then it takes away from the expense or distribution, which you, again, equity is a factor. So if you can take away, minimize expenses and minimize any distribution as an owner, then you're keeping your profit high and you're keeping your equity high. So then, you know, as you usually grow, just like any business owner usually does, they don't really pay themselves because they're trying to keep things afloat. And then later down the road, you can pay as you make more money, and because you can kind of manage your equity a lot better. Because keep in mind, equity, and I know y'all probably tired of hearing me saying, but I'm just here to tell you, equity is the driver of this composite score. And the equity is just the biggest factor. And the biggest thing I can do is review your financial statement, especially if you're getting near end of fiscal year, because we're in the middle of September now. So that's the biggest thing, is look at your financial statement, see where you at, and plan before the end of fiscal year. So that way, when it's time to do the audit, because you're going to have an audit done no matter what. So when it's time, you rather know that you're going to pass instead of not passing, and then you may have to wait a whole nother fiscal year in order to make sure that you're deemed ready for that financial standard.
And y'all should probably be paying y'allself by cutting hair, doing y'all services, which y'all clients paying you all. I wasn't taking money out of the school account before I got accredited. I didn't start doing that until after I got accredited and started getting, you know, government funding, the Title IV money. So, and then if y'all have employees, my first employees, she got paid a little bit from the school, and then she got paid other ways. I can tell y'all, I paid her with cash from money that I made from cutting hair or whatever. Auditors, a lot of people probably, they're not going to tell y'all this or whatever because they may be unethical or whatever, but I'm not a school owner anymore. I'm retired. So I can tell y'all everything that Ms. Velma taught me in order to get to that next level. So you want to keep them expenses as low as possible, because all that money you're paying out through the school, that's just making your expenses higher. So, and there's some other things I can share with you all offline, people in the program. I'll share with you all privately to make sure y'all pass, but this will be on YouTube, so I'm not going to share everything on here. We'll keep going. Let's see, very informative. I use QuickBooks. Will you get penalized if you don't have the proper equity saved up?
Yeah, it's not, I guess, in my mind, not being penalized, is that either you pass a composite score or you don't. And if you don't pass a composite score, I don't see how NACCAS is going to be deemed ready, because you can be ready on the academic side. But one of the standards for NACCAS is the financial statement standard. And the part of the financial statement standard is having a composite score 1.5 or higher. And if obviously you don't have the right equity in account and you don't pass a composite score, you may run into a issue where NACCAS obviously is not going to deem you ready, which can affect your, candidate status and moving down the road. So the goal is to be deemed ready, get that composite score 1.5 and higher, 1.5 or higher, and to keep that as you go. Because even let's say you pass it, you get Title IV funds. If you don't get it, once you start participating in Title IV, the composite score is a big thing the department looks for. And if you don't pass that composite score, once you get Title IV funds, they put you on heightened cash monitoring. You got to post a letter of credit. NACCAS and other accreditation agencies, whoever you all go through, will do their monitoring too. So the composite score, I can't drive that home enough, is the biggest component of the financial statements.
Okay, so if you were a school owner, knowing everything that you know now, and you opened a school on a shoestring budget, like I did, very limited funding, barely got open or whatever, you didn't make a whole lot of money leading up to accreditation, through accreditation, what would you do?
Well, first thing, like I say, first thing I would do now, know what I know, don't have no liabilities, zero out as much liability. I mean, some counts, some things you can't get rid of, like payroll, if you accrue that at the end of the year, but in credit card statements, if you can try not to have that kind of debt, reduce your liabilities to next to nothing if you can. That's the biggest goal. Increase the equity as much as you can. What I mean by that is either on your profit and loss, increase revenue as much as you can, obviously reduce your expense as much as you can, contribute as an owner, even whatever you can find money to contribute to get that equity up, and definitely get with me before the end of the fiscal year so I can see what your financials are looking at, your profit and loss and balance sheet, so that way we can plan before your fiscal year ends, so that way there's a good chance that you meet your composite score. And I hate that you'll don't do it, you go through the end of the fiscal year is done, and then it's time to do the audit, and then you don't pass, and then it's like, I wish I had that time back to sort of strategize to make sure that you pass the composite score. Because then, waiting a whole nother year can, be a whole long impact, especially as a school owner, because you're ready to get Title IV, you're ready to participate, ready to offer those kind of services to your students. So,
on audits, let me see. But yes, Ronnie, you can contact Nathan. Okay, how far will that push you back for accreditation? How consistent? Well, if you don't pass the financials of that audit, then you can do another one the next year.
yeah, you can get another audit the next year, but the goal is, like I said, you still have to wait that time, and then you're still planning and hoping you pass it. Like, you still have to have it done, but it's obviously, as you go through accreditation, you want everything passed on the academic side and the financial side, so you'll flow, smoothly. So that way, your next step will be, once you get accredited, you can start with the process with DOE, because that takes time too as well. So, but if you're holding out and you miss it, then they're not going to deem you ready, and then obviously you're waiting a whole nother year just to make sure that you pass it, and then that it just pushes the clock back, basically.
What do you think about the wave accounting system?
Yeah, I mean, I don't really deal with too many clients with the wave. A lot of the clients that I deal with either use, majority of them's QuickBooks. QuickBooks is the big accounting system that I see a lot of folks use as proprietary school owners, and when they even outsource it to other individuals, most of them use QuickBooks.
And Gerard, I'll talk to you about those passing those audits and stuff, some stuff that Ms. Velma taught me, but that'll be off record. Any other question? I don't see any other questions. You shared a lot of good information with us tonight, so I know a lot of people are going to learn from this, and I want to put your number up again, Nathan. How can they contact you? Can you?
Yeah, the best way to contact me, they can either reach me by text, but call me 214-263-7705. You can text that number, or you can shoot me an email. My email address is Nathan, Nathan, at Nathan, Nathan, Ferguson, Ferguson, CPA.com. That's my email. But the best way to, like I said, reach out to me, you can do email, or give me a call, or even shoot me a text at that number, 214-263-7705, and I'll be back in touch with you.
I just put Nathan's number up here for you all, and I'll put the bookkeeper up here one more time. And I'll just put book. All right, so make sure that y'all contact Nathan, because y'all definitely gonna need him. And don't be scared when you contact him. He
No,
did-
reach out to me. I'm here to help. So
Yeah, he's a nice person.
yeah.
If your books are not in order, he's helped a lot of schools out there, people I've personally referred whose books were not in order. So it's not like your book's all out of order and he's gonna get you put in jail and all that type of stuff. Because I've had people to call, is he gonna give me? No, he's
No.
gonna get you in order so you can get through NACCAS and move on to this next level. All right, anything you want to, what's your theme song, Nathan? We're leaving with that.
Oh, you hit me on the spot. I guess I always have to say the man's right there, I guess, you know. So
That's is that mystical?
yeah, buddy, the man.
Oh yeah, old school.
Yeah.
All right, y'all. So we had Nathan on here. And we're gonna go ahead. Let me go ahead and stop this recording.
No worry. God bless everybody.